So our new ROI is 20%. Let's go to 5. Alright, let's go to 5. Now we got to use the given information at 1. Assume Roundbelly Management was able to do the following. Reduce operating expenses by $25,000 without affecting sales or operating assets. Alright, so the equation, return on investments, ROI equals $750,000 of sales divided by $300,000 of average assets or invested assets. But we were able to reduce expenses, which would have increased net operating income by $25,000. So we went from $45,000 plus $25,000. We got a new operating income of $70,000 divided by sales of $750,000. That gets us ROI equals $2.50 times 9%. ROI equals 23%. Moving up to 6, residual income example. The sailboat division of HMS Roundbelly Inc. has average operating assets of $250,000 and is required to earn a return of 17.5% on these assets. In the current period, the division earns $46,000. Management needs to determine if they've met the required rate of return. Alright, so we take our residual income equation. Residual income equals net operating assets minus average operating assets times minimum required rate of return. So residual income equals $46,000 minus $250,000 times 17.5%. Residual income equals $46,000 minus $43,750. That means residual income equals $2,250. Management met the required rate of return on residual income because it's positive, right? So management met the required rate of return as residual income is positive. Going to 7. This is the ROI versus residual income example. The sailboat and accessories divisions of HMS Roundbelly both require a minimum rate of return of 17.5%. The two divisions have the following operating assets and actual income. Alright, so we had for the sailboat, $250,000 of sales required, of operating assets. The required rate of return was 17.5%. A minimum required rate of return was $43,750. You saw that from above. Actual income was $46,000 minus the $43,750. So for the sailboat division, as in number 6, the residual income was $2,250. Now the accessories line had operating assets of $2,250,000, and they had the same required rate of return, which is 17.5%. So their minimum required return in dollars was $393,715. Now, so the actual income for the accessories line was $400,000. You take the required rate of return, subtract it from actual income, and we have a positive rate of return, a positive residual income of $6,250. So they did meet the required rate of return. However, let's look at it in terms of ROI. Management notes that although the accessories division had a greater residual income, it required a disproportionate amount of assets to do so. Let's look at the ROI. So we got the equation ROI, investment and income, equals we can eliminate the sales revenue and come up with the equation that ROI equals operating income over invested assets. If we do that for both, we get the sailboat division ROI is 18.4%, and then the accessories division ROI is 17.78%. So we see that the sailboat division actually had a higher rate of return because they were using less assets to produce their income. So it's important to note the difference between the two. The residual income only gives you a dollar value, and so that dollar value was greater. But if you look at it as a percentage of assets or your return on investment in assets, it was actually less. So those are the methods that management uses to monitor the business segments. And business segments are, investment centers, profit centers, cost centers. They can be sales territories, service centers, individual stores, marketing departments, individual customers, product lines. Anyway, that's lesson 9.